Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook and your host for the next half hour here on Options Guide TV. All right, well, this is the big day. This is a day that I've been thinking about for quite some time, mainly because the debt ceiling was a warning about what could happen in the marketplace, but now it's time to come up with a new budget. And it looks like it's highly anticipated at this point in time that they might not get the legislation done to kick the can down the road and at least give another 90 days or 45 days to continue to have discussions. So it is a scary day in the markets, and we do see the markets trending higher, which to me would kind of imply that maybe they're going to get a deal done. At least the marketplace thinks that. And we did see the VIX actually come off a little bit. Right now, we have the VIX trading at 1620, which it's been up over the 18% level for a few days, and now it's kind of waned off. We got the SPX up $16 today, almost a third of a point. But once again, we've just been hanging around the 4,300 range. And our SPX trade, which is where we started this little bearish trend in the marketplace, we bought the 4,305 strike and we sold the 4,285. So we came all the way down below our short strike and we doubled on our butterfly. But we talked about the fact that we went out farther in time, and because of that, you needed to have realistic expectations going into the trade that a doubler was a good trade, and don't be hanging around trying to hit that home run. Now, we did get a great question, and if you do have any questions, please feel free to put them in the chat box on YouTube. I will try to address them during the show, and I want to make this as interactive as possible. So if you have any questions, please feel free to put them in there. But somebody did ask if I did have more than one position on, would I maybe sell half of it? And yeah, I would have. And right now you'd be sad that you did that, right? Because the market is now, excuse me, the market is now at 43.17 on the SPX, which is above our highest put strike, which is a bad thing. It means it's not within our range of 43.05. So that's fine. We're just going to leave it there. We're going to let this, the big news is coming. We'll see what happens on Monday. Monday's going to be a very interesting day as far as the SPX and all the markets are concerned. I'm surprised to see the VIX actually coming off a little bit today, even though we do have an up market. I'm just kind of surprised to see that. What really drives the VIX? Let me grab a little bit of water here. What really drives the VIX is that people run to the SPX index and they buy puts, which drives up volatility. So even though the marketplace may be muted as far as actual volatility, you can still have the VIX run up because the actual volatility hasn't been wild swings. We're not getting 2% swings in the SPX and the NDX day in and day out. They're usually less than 1%, but they've been to the downside. Okay. All right. So then let's review one other trade that we're going to look at. And that was what we did in Costco. Costco this week, we talked about trying to get long a stock. And the one highlight of the economy has been the consumer. Costco has seen inflation. The numbers actually come in on both sides, on apparel and on food. And they haven't had as much issues like Target has had with the theft. Target's shutting down a few stores. Costco has a different kind of setup where all their stores are located at. And they just really haven't had the trials and tribulations of a lot of the other retailers when it comes to that space. And because of that, we decided, well, if there's one place to get long, let's get long one of these companies that still should participate if we do have a downturn in the economy. And, you know, if the Fed keeps pushing as far as interest rates are concerned, that's still on the table. but we had really good numbers from the PCE. As a matter of fact, there was a quote by Moody's saying it's about as good as it could get. So on the goal of getting inflation and CPI down to around the 2% level, we've had good numbers. We had good numbers in the marketplace. And that's probably a big reason why we're actually seeing the market up today, even though we still have this pending news that's going to happen on Monday. So with all that said, if we look at where was I going with the Costco trade? Oh, if we look at the Fed Watch tool, the probability of the markets actually doing a quarter percent rate hike in November is all the way down to 12.7%. So the numbers have really been good as far as inflation is concerned. And now the Fed fund, or the Fed, I should say, the futures contracts are implying that there's only about a 12% chance of the Fed actually raising or hiking at the November meeting. And prior to the Fed speak and all the news that has recently came out, the last meeting that they just had, that was up around 40%. So numbers have definitely dissipated as far as probabilities are concerned. And yeah, so the marketplace the numbers have been solid. There's still a lot of landmines that are out there. Energy is one of them. That's a tough one to tackle. We've gotten long some energy stocks recently on Options Guy TV, but the fact that oil is at $92 a barrel, at least the futures contract is, that is obviously one of the concerns in this environment. But it's also, oddly enough, the fact that oil is strong and that the consumer is still strong. It kind of shows signs of just a resilient economy. Let's just leave it right there. And then let's look at the VIX trade that we're going to talk about. Major news event coming on. VIX has been all over the place this week. We're going to actually go to the TradeHawk software now, and we're going to look at the options grid. And we're going to do a couple of weeks ago on a Wednesday, a little bit more than a couple of weeks at this point in time, we had Russell Rhodes, who's written the Bible as far as the VIX is concerned, has written a few books on the VIX. And he talked about a trade that we actually did on Options Guy TV, a paper trade, as always. Nothing's ever meant to be a recommendation, where we actually sold a put spread to buy an out of the money call. I said that in his next book, he should try to come up with a name for that strategy. And I do believe that, because in the playbook, we named one of my favorite trades, the fig leaf, and that name has taken off. If you don't believe me, Google fig leaf option strategy. Make sure you put option strategy in there, because you don't know what you're going to end up with if you just type in fig leaf. But that strategy, he said, is one of his favorite things to do in the VIX index, where you sell a put spread below the marketplace, bring in a credit, limit your risk, and then use that credit to buy an out of the money call option. And in my instance here, we're going to do a shorter term option contract. And I was very happy to see kind of where the futures contracts were trading right now. And so I'm looking at the VIX October 18th date. And for right now, I think we're just going to call this strategy an RR. And I've heard today from our producers who have roots in Africa that an RR is a very popular drink in Africa. So maybe after putting on this trade, you can go out and have an RR. And I'm sure that you can find the ingredients in an RR online if you'd like to look into it. But that's just, we're going to take Russell Rhodes' initials, which is just fun to say, by the way, Russell Rhodes. And we're going to do this RR in our trade today on the VIX on the October 18th expiration. So having a little bit of fun. Now, this isn't a trade for the light of heart, right? This is a very speculative trade in the VIX, because we're doing it so short term. And if I look even at the VVIX, I'm kind of surprised that the VVIX actually is trading around 88. It's not up over the 100 level, but the VIX, that is the VIX of the VIX. The volatility of the options inside the VIX index is what the VVIX is. And a lot of times in very scary moments in the marketplace, that is up even higher than the 88 level. So a lot of times that can trade as much as 140, 150, the VVIX can. So with that said, we're going to look at the VIX at 16, go out to the October 18th expiration. We talked in detail about the fact that the actual expiration date follows the futures contract on the VIX, not the cash or the spot. And when you type in the VIX index, VIX, and I'm going to point to it right now on the TradeHawk software, and when you type in that you're quoting the spot. So we need to find out the value of the actual futures contract on the October 16th date. And the way to do that is you actually do what's called a combination. You look at an at the money strike. Like right now, we can see if we look at the 17 strike, and we'll just compare the ask. It's a fairly tight market, so that makes it a little bit more accurate. But if you look at the 17 strike, you see that the call and the put are trading for very close to the same amount, but the put is a little bit more. So if you bought the call and sold the put, that would be a net credit, and that's what you would subtract from the 17 strike. Right now, the actual VIX is at 1627. We do got the October 18th date. I always want to confirm that over here. So if we bought this call, that gives us unlimited upside, right? And we pay a net debit for that. So let's go in. Come on. Looks like my screen just froze. 1 second. Do I need to refresh? Everything's looking good. Okay, except for my screen is. There we go. Yeah. All right. We kick-started that baby. All right. So now, October 18th, let's go back to that expiration, and here we are. So if we look at, there we go. Oh, my whole screen's shifted on me. All right. So let's pull this back. That's what was going on. Okay. Ask and bid. These are all that really matter here. Okay. So if I look at all the quotes changed on me. All right. I think we are now cooking with oil. Everything's back to normal. We got the bid and the ask where we need it. We have the October 18th expiration date, and we see the 17 strike call on the ask is trading at 123, and on the put is 139. So we're going to buy the call. We're going to clear this out. We're going to buy the call. We're going to sell the put. That's one of the headaches of using live markets here on Options Guy TV, but that's what we always do. So at this point in time, it is a small credit of 16 cents to the account on the midpoint. So we take 17, where the market is at, $17. That would be the strike price that we'd be putting our combination on. And we subtract 16 cents, and we see that the futures contract right now would be 17. I'll clear this out. 17 minus 0.16, and we get to 1684. So we're a little bit higher than where the market's at right now, 1684. All right. So on the downside, we want to try to get something that's going to bring in enough of a credit to try to help us. And there's really not a ton of juice. Like I said, the volatility index, or the VVIX, is fairly low at this point in time. So we're going to sell the 15 strike put, and we're going to buy the 40 strike puts. And maybe we'll go a little lower. Let's do the 13. We're going to put a little bit of risk in this. So we're going to clear this out. That's what was telling us where the futures market is at. We'll clear this out. We are going to sell the 15 and we're going to buy the 13. And we're going to pay next to nothing for that 13. So we're going to bring in a net credit to the account of 43 cents. So then we're going to go on the other side of things, and we're going to try to find something that is feasible. I'm not looking to pay for the whole thing, but on the upside, the 20 level is always a tough level to try to get through. If it breaks through the 20 level, well, that could be a good thing as far as this market is concerned, or as far as this trade is concerned. It would be a bad thing for the markets because it obviously means when the VIX goes up and volatility and nervousness happens, then you usually will see the marketplace go down. The SPX will usually go down in tandem as we see the I don't know about tandem, but if the VIX goes up hard, usually see the marketplace going down hard. Okay, so 19 is a strike that I would like to buy. I would like to buy this one, but to me, that's too expensive. It's 76 cents. So I'm going to go up and I'm going to go a little bit further out of the money because we got a 43-cent trade and literally we got $2 of risk on the downside. And we're going to have, and I don't want to add too much more risk by paying too big of a debit. So I'm going to go up and look at the 20 strike put. Now, if I click this buy in here, we officially have the R, the Russell Rhodes. We're selling the 15 strike put. We're buying the 13 strike put. We're taking that credit and we're trying to buy an out of the money call in case we get this big swing up. We're going to go out to that October 18th date is going to be that expiration. And we're going to get this done for a net debit of 5 cents to the account. It's going to cost us 5 cents to put on this trade plus the requirement of the short put spread. So if there was ever a time that we wanted to show the what if calculator on a trade, this is a great time to do that. So let's go on up. And I'm going to emphasize here that with this trade, this is really a paper trade. This is a speculative trade that's going to be fun to watch that we're doing on a Friday. We did a couple of more serious trades, like we got bearish with the SPX butterfly. We got bullish with the Costco trade, which that is up about $5 actually since we put on that trade. The stock is at least. And now we're going to try to come up with a fun trade just to have a position on going into this major Monday, I guess we would say. Major Monday. Maybe I should trademark that. So with that said, Major Monday. Here is where our risk is. So if we go and put on this trade from 13 on down, from between 21 and this is 15. There's the 15. Okay. Between 21 and 15, between these ranges, we only lose 5 cents. If we can get above 21, we have unlimited upside potential. If we go below 15, we have $2 worth of risk on the downside. So we're putting this trade on, realizing that there's a good chance that basically nothing happens. We lose that 5 cents. That's actually the highest probability that could happen. And then if it goes down, we have the risk to the downside, down around, we could lose up to $200 on the downside for our 1 by 1 by 1 Russell Rhodes that we have on, our RR. And then on the upside, we have unlimited upside. So if we get a spike up on the call side, we can just sell the call and get out of that position. And that's what I would suggest doing. If we had a spike up to 25, 26 in the VIX, I'm going to sell the call option as soon as I can. I don't want to stick around. There's not a ton of time left in that trade, but that would be my range that I would want to try to sell it and get out of that position on. And it's probably a spike like that would probably happen somewhere around the open. That would be the probability would be higher to get a big spike up in the VIX right around that opening. All right. So if you have any questions, please feel free to put them in the chat box. We'll go back to the actual trade screen, and I'll show you here on, by the way, just let me run into Costco real quick. Just wanted to show, because the chart is interesting, and I meant to talk a little bit more about it, but just look at these highs, and we actually are all just hanging out, came all the way up to a new high and then sold off. If we can make a strong move, we're selling off a little bit to, oh, now it's back to actually up. It's in the green. It was down a little bit before we started. It's only up 11 cents. But if we could actually finish above the, let's call it 572 range. Oh, no, that just moved on me. Okay. Above that 572 range. Well, in that instance, then this might be a breakout. On our call option on Costco, our strike that we sold is the 595. That's the only range that we want to be a little bit nervous on. But I like the way the chart's looking. If we and you could also look at it as, if we don't break out, that's obviously a very bearish thing. But we did have the golden cross that happened here right at going into earnings, where we had the 20-day crossover, the 200-day or the 50-day. Come on, Brian. All right. And when that happened, that is a strong sign in the market as far as moving averages are concerned. And there you go. All right. No questions. That is fine. And I think that's going to be it for this episode of Options Guy TV. So, very interesting day on Monday. I'm very interested to see what happens in the marketplace. Been discussing it for a while. I want to get this event over. It'd be lovely if we can get this event past us. And I really don't, at a very minimum, the best thing that we're going to have happen is probably kick the can down the road. But at least that would be something. And then we would have another day that we would have to target. But we'll come back, and on Monday, we'll definitely look at this trade and see where that VIX is at. And thanks for coming. Please click subscribe. Ring the bell. Make sure you get all the alerts here on Options Guy TV. And as always, please pound that thumbs up. It helps us out. So that's it for this week of Options Guy TV. We'll see you this coming up Monday at 11 a.m. Eastern time for the next edition of Options Guy TV. Thanks for coming, everyone.